This is Satya Pradyuman of Cirrus Research. The briefing is just out. The title of this month's report, Software Dispersion Opens the Door to Active Management. We've seen, finally, in the last year, a recovery of the software names. What we're starting to see is a thawing of the blind selling of the entire software sector due to the AI disruption threats. This chart represents the dispersion of software firms, their returns across. It's a cross-sectional look. What you'll notice is the dispersion of the larger software firms that has begun to increase. What it means is that investors are no longer just blindly selling baskets, but where they're looking for opportunities. One of the areas that's recovered sharply by over 30% in the last month of May is the cybersecurity sector. In other words, this is potentially the beginning of where the software application software names are beginning to bottom. Investors are now being able to look at individual firms. In other words, active decision making looks like it's starting to surface. Going back to the dispersion data, one interesting note is that the smaller cap dispersions are still on a historical basis quite low. What we believe happens is that that's likely to become unlocked as well, because these two groups, they tend to track together really well in terms of the way the sort of dispersion of returns. So we think there's a positive sign there for active managers as we move through the months. In addition to that, we've spoken a lot in the last year about market broadening and how not only overseas markets are outperforming that are not even AI centric, but also the smaller cap arena, which is clearly not an NVIDIA trade. However, what we are seeing is that this broadening has been occurring for over a year now. What you'll notice is that sector for sector, we'll see the AI trade that's now starting to becoming more distributed, looking across industrials, materials, and technology. What that's doing is amplifying smaller cap returns because so many of these firms are also in the mid-small cap arena. So as the AI development continues and it becomes to be spending becomes more broadly facing, what we're finding is that all of these other companies are now starting to get a bid. And the math of it is that if you take a certain amount of money and put it into a $5 trillion company, the rate of return may not be as dramatic as you putting it into a $2 billion company. And so that's what we're starting to see. In addition to that, though, when you look at the sector spreads, it's not just the AI verticals that are benefiting in smaller caps. What you'll see is financials, utilities, and real estate have also outperformed in the past year. So this broadening, I think, is driven by a crucial factor, which is the idea that if globally investors are getting a bit nervous, trading partners are starting to move into their own corners, this is when you get this sort of fractious pattern. What also occurs is that valuation starts to matter. The international markets versus the large mega cap US, extremely discounted. The US smaller stocks, extremely discounted. So we think that's what's really behind this more global rotation. In addition to that, what we're also seeing is trending is back. The idea that investors might have put on pause due to the initial steps of the Iran war, but they're now coming full bore into this AI play across the cap spectrum. We think, though, that this is going to become a little choppier because we're now starting to see speculation levels pick up again, not unlike the sort of peak levels reading we were seeing last summer, last fall. Take a look at the full report, and as always, happy to take your questions. Thank you.